Hello, everyone, and welcome back to Your Finance TV to kick off your work week. And as we always do on Mondays, we sit down with Brendan McCarty from Column E. How are you, Brendan?
I'm great. Good morning to you.
Good morning to you as well. Before we jump into it, don't forget to click on that like and subscribe button. We've jumped past 3,000 subscribers now. Thank you so much for your support and your continued support. All right. Now, the Fed is in blackout period this week. But at this stage, the street is thinking that it's pretty well unlikely that we see a 25 bip hike on July 26. We're going to have the latest Empire manufacturing data, June retail sales, existing home sales, and other jobless claims results as well this week. But what is going to be the main focus for the week are earnings, with big names like Netflix, Tesla, and IBM reporting, just as a small example of that. But before we jump into that, I want to look at a couple other things. Let's go back in time, Brendan, about 18 months when Russia invaded Ukraine. Remember how there were huge concerns about Ukraine being able to export grain? Well, that deal allowed Ukraine to export grain through the Black Sea, and that deal expires at 5 p.m. Eastern Standard Time today. Russia has already said that no plans for extending the deal, blaming the West for blocking its exports. And unless they do some changes on that front, Russia's not going to come to the table. Brendan, what sort of ramifications could we see on the back of this news?
So I don't think the market really cares as much necessarily about Ukraine not being able to export wheat because Russia is such a major player. It's the biggest player in the world, according to the USD report that I was reading. This is more of a public, what the right word is, but if Ukraine can't sell wheat, that hurts their economy and their people don't eat or they don't make as much money, and that hurts the farmers. But the Russians have already been like taking up all the loss of Ukraine wheat to the markets, and Russia's been like making up the difference. Wheat prices as a whole, I guess, have reflected this. They peaked last summer, and they've been coming in, and we've been like I look at every week at the rundown, Monday morning rundown, and wheat and the ag sector, beans, corn, they've all been terrible. And wheat just started waking up over the last few weeks, last 2 months. Nice turn in June, incidentally, but it's still way off its highs. And I think all you saw lately of the move of wheat was largely, all right, what if this Ukraine deal doesn't happen? Should we cover our shorts? Because some of these guys are up like 50% in the move. From high to low, it was down over 50% in the year. And we're going into a big season where I think wheat is, I know there's different types of wheat going back to my commodity days, but in general, wheat prices, you usually see a bounce around now, and they haven't been. We see a bounce heading into this news with Ukraine, and it's sort of like, all right, let's just cover our shorts and see what happens. But I don't think it's that, long story short, I don't think it's that big a deal because I think Ukraine is only like 18%. I can't remember exactly the number, but like Russia's like a behemoth compared to Ukraine. So if Ukraine's not exporting wheat, it's not that big a deal. The U.S. is still the largest second largest exporter of wheat. I think they covered it heading into this. This morning, they're higher by about 3% heading in. I don't think the deal's not expired yet. Is it tonight? If I'm not mistaken.
Tonight, yeah.
5 o'clock. So they're covering shorts, I think, into this. I don't know how, there was a massive explosion in wheat 2 or 3 weeks ago, and they sold into it heavily once it got to the 65-week. So I think the prices are still lower. I think they're covering into this news. And then once we get through the news, wheat prices won't be that big a story again. I think we have a very big oversupply of wheat globally. Russia's selling theirs slightly cheaper than others, which could explain why we have bigger supply. I'm not a big wheat player or trader or anything, but the numbers themselves argue that there's a lot of supply of wheat out there. And that's why the prices have come off. And this little Ukraine deal, will they or won't they, probably won't matter in the grand scheme of things unless Russia decides not to export wheat at all, which they're not going to do because they need to finance their war with it. So I think we're seeing covering, and that's nothing more than that at this point.
Yeah, it's also a different time of year, right? It's summer in the Northern Hemisphere. So a lot more production of wheat coming out. Obviously, when they did go to war, Russia invaded Ukraine, that was in February time, so winter time. So obviously different seasons can be different results as far as the prices on the wheat side as well.
Yeah, it's a tough market. I've never been able to figure it out, that market. I always saw them bottom in the spring around here, and then rally into the summer, and then whatever happens in hot summer or droughts or whatever. Wheat turned, but it's just so beat up, and you look at beans and you look at corn; they're also not doing so well. We got oversupply everywhere. I think it looks like it, unless charts lie. But I guess it's an event, but I don't think it's. If it was such a big event, you'd see wheat on the move more quickly, because it looks like it's not going to pass, and Russia doesn't have to pass it. Like, it's just what it's. Unfortunately, it's a side effect of the war.
We'll see what happens on that front. Okay, we also looked at small cap names a couple of months ago. And I wanted to take another look at this space on the back of an article I read in Seeking Alpha yesterday. Stonefox Capital said that the signs of inflation problems, I should say, are coming to an end, and that rate hikes are nearly over. And that has the Russell 2000 stocks rallying, and that with investors focusing on the Magnificent Seven stocks, that investors should really be looking at small cap stocks in the Russell 2000. Brendan, is it time to jump into small cap names, or maybe even just dip the toe?
So the small cap move began like 2 months ago, really. We got positive. Charts looked really, really extended to the Magnificent Seven at the beginning of May, and that looked like a great opportunity to get long small cap. And since then, it's done. The small cap 6 has actually done quite well. Last week, the chart showed a really nice move. Small caps have been dragging behind, but slowly closing the gap. Like they haven't been the leadership until lately. They exploded out this past week. They're outperforming, but incidentally, mid caps, which they tend to follow each other, mid caps and the small caps. The middies sort of, not to take a lacrosse term here, but the middies sort of like were holding better than the small caps. Small caps were seeing the selling. Middies kind of held pat, and then all of a sudden the small caps like flew right by them. So while I like the small cap move in the short term, the fact that the mid caps didn't really join them as much lately is kind of a bother a little bit. I think the move in small caps started 2 months ago. So if you're jumping in right now, yes, you're riding that beautiful breakout from last week in the small cap 6. It went over the 65 week. It went past 1225. I think it's going to run. It could run another 10% on that index. It's a smaller index, of course, and incidentally, I watched that one more than the Russell. But I'll just say that if the mid caps don't really join the fray, if you will, that might slow the smalls down in a way. Also, this story about inflation slowing, it's kind of in the market already. Like, I think we've already all noticed that the CPIs were slowing down, and the Fed already paused. So I don't know if it's still a big story, as these guys are saying. They sort of seem to be a little bit old on it, but I'll just say that inflation, I don't know if inflation necessarily is slowing. We did a video talking about the CPI rate of change. It looks like it's actually turning back up, the headline CPI. If that trend continues, in the 10-5s curve actually has been a good signal of the CPI headline CPI over the last year. 10-5s turned up, so the curve is steepening. 2s are selling. 2s are finding buyers. The bond is not finding buyers. The curve is steepening. So if the curve is steepening, that argues that we're seeing a higher overall level of inflation. I don't know how good that is. That is not necessarily friendly for a small cap company. But right now, the rallies, and right now, as like we said on Friday in another video, we've been getting into videos like crazy lately. For the S&P, the only variables that were driving the S&P were risk and price action. Well, the same thing's happening for the small cap. So you ride this until the market says otherwise. It literally, there are no variables supporting any of these equity markets right now. Forward EPS numbers are way out of whack relative to risk, but the trend is the trend, and you got to play. I mean, the momentum guys are going to play this. The breakout last week in small caps is powerful, and the small cap 6 looks like it's going to run. It's just, you got to be careful because the variables supporting these equity markets don't exist. So it's one of those things where price action is price action, hard to ignore, but you got to ride it. I just think this move in the small caps has been 2 months in the making. I mean, it literally, the lows to buy this were May 5th. Mid caps joined on June 5th. We're now 2 months into a strong move. I don't know how much more. You'll probably have that move to the maybe 5 to 7% higher. 10% is the target, but I don't know how much more they'll be there. And if risk falls out of the equation from investors, it won't get there.
All right, now we're going to look doing some earnings previews here, and two companies we're going to preview are from viewers that have asked to look at a couple of different stocks. So if you do want to have a look at some stocks for earnings previews, please send in your requests and we'll take a look at it for you. We're going to start with Synchrony Financial, and their symbol is SYF. They report on Tuesday pre-market. They have a great track record for beating estimates, and they've beaten 3 out of the last 4 earnings periods. But that one miss in there happened last quarter. That was when fears of smaller and regional banks were front and center with everyone. The share price was sub $30 then, and it fell below $28. Since then, it's been one-way traffic, and their share price is near 2022 highs. Brendan, we've seen spending continuing to be robust. Do you think this can help Synchrony maintain this upward momentum?
I'm not so sure. If you look at overall credit numbers in the system since last summer, they're flat. So credit is not expanding in the financial system as a whole. That doesn't speak to SYF particularly because, the big banks are also part of this equation. But, the overall credit trends are credit trends. And I think the consumer is taking wealth more than credit cards into use here. Let's look at it this way. If there was a time where you could borrow credit at like 5 to 7%, equity markets would rally at 11%, 10, 12, 15%. Well, you would leave your wealth alone and you'd borrow at 7%, right? Now you're looking at 20% on average, 21% on credit. And while the NASDAQ is up 38%, the S&P is not up 20%. So you're still lagging behind wealth versus credit. And I think that could be a reason why credit really hasn't expanded, and you're seeing the consumer tap into wealth, if you will, to spend. It doesn't slow down the consumer spending and whatnot. But SYF's numbers are supposed to be lower than a year ago at this time. So I would just say that, is it possible? I know they have to follow the prime rate and whatnot where they raise rates, but I think it's like the banks. The banks overplayed their hand by not spitting out interest to bank owners. And then all those bank depositors went into money market funds, and that caused the run on the banks in March. All these credit card companies are charging 20, 21, up to 29%. I wonder if they're overplaying their hands on credit and driving people out of the credit cycle. I don't know how they drop it lower. Credit is credit. It is a risk measure. But I wonder if they're suffering as a result of they should be benefiting dramatically on this nice spread. But I wonder if they're actually not benefiting from it because the rates are simply too high. Like, there's that balance. Like, deposit rates, you were earning nothing on your bank deposit, so you ran into a 5% money market. It's no brainer. Why wouldn't you? You move the money over to the brokerage side. Like First Republic, we were earning nothing on our balance and our cash. We move it over to the money markets. We're earning 5%. Well, the banks realized they had to start jacking up their bank deposits. Is it possible that SYF and others have to drop their rates? I don't know. But SYF's numbers are not higher than they were a year ago. So for this story, the stock has run right into resistance of I think it's the range since June of last year. I think there was one breakout of this range and it failed, came back. I would just say that they need to report better, closer number to last year than like right now. I think they're expected like 125 or something like that. 140 is what they earned a year ago. They get closer to 140, I would see the stock break out. Otherwise, it's stuck in the range. It's not really an exciting story because I think maybe they don't have the ability. I don't really know credit well enough to say they could drop credit rates. But like we started getting teaser, personally at home, we started getting teaser rates from Citibank. So the big banks, I think, see that rates are simply too high to get the consumer to spend on credit cards. And I think they have to go lower. So I think until that happens, until rates start to drop on the credit side, the SYFs of the world won't see robust earnings.
Okay, we'll see what happens to that tomorrow morning. The other company we're going to look at is Las Vegas Sands, symbol LVS. They report Wednesday after the close. It hasn't this been a great story over the last 12 months? The stock's rallied nearly 78% over that period. Last week, CBRE upgraded estimates for US casino operators on a Macau recovery story. Looking at the share price move last week when the stock rallied nearly 10%, maybe investors are thinking the same thing ahead of these earnings. Brendan, what do you think we could hear from Las Vegas Sands?
So first thing I thought was their update on sports gambling. They're not even in sports gambling much. I mean, they got a great sports book at Wynn, but aside from that, I haven't been there in years, so I have no idea how good or bad it is. I would just say this: they had a great week from last week, but they said short interest fell across these names last week as well. I don't have any detail on who wrote that, but MGM's short interest fell last week as these stocks rallied. I'm guessing the shorts are covering here as well. Equity markets won't give in, so the shorts maybe have given up for the summer. Who knows? And they're covering in the LVSs of the world. It ran right into 61, which is resistance, similar to what SYF has done in terms of running right into resistance. They're all about Asia. They have headquarters. I guess things you learn, I guess, right? I thought they were bigger in Vegas than they are, but I guess it makes sense. They're not really big. They're headquartered in Vegas, but they're largely all of Asia. So we'll get a good read on how strong this recovery in China is. I mean, I've said it many times here. China's recovery has been uneven. When the prime minister is constantly out saying that we need to put stimulus into the economy, that argues that they're not recovering as much. It doesn't stop Asians from gambling, the Asian markets from seeing gamblers, of course. Japan's stock market's been rocking and rolling, so perhaps that wealth expansion there will lead into Macau of sorts. Macau's numbers are expected to be tremendous year over year because a year ago we were closed in China. So I think maybe, I don't know, but they said Macau's numbers are supposed to be like roaring strong. So that puts on the table miss risk. If you have these massive numbers, that risk alone could come into it. But LVS's numbers are supposed to be the best since 2020. They haven't reported this strong enough earnings-wise in Asia's. I didn't realize that last year they took a $3.8 billion profit on something that gave them profits last year when they should have reported a loss on a sale, I think it was. So they were selling a lot of things last year. I'll just put this. I think the stock has had a nice run, but I think there's missed risk on the table with this name just due to a weak China. The Hang Seng remains in the doldrums. Japan's really, I haven't looked at South Korea's stock markets, but the Nikkei's backed off, even though the Nikkei has been screaming. The equity markets over there tend to be a good proxy in terms of gambling, in my opinion, or they always have been. So this comes down to how strong the Japanese recovery was relative to the Chinese weakness and where Macau falls in between, I think. I would just say that there's missed risk on the table with this earnings report. Very positive thinking, Macau reopening, China reopening. If they don't miss and they beat, the stock's going to scream. I think the shorts got out of it last week, so I don't know how much past 64 it can get. But if they were to beat on earnings, 64 I think will be vanquished and they'll slide right through it. If they do miss, they'll retrench everything from last week. So this is a pivotal report for the stock. This is the best report they might report in 3 years. So there's a lot of optimism behind it, a lot of expectations that they'll do well. I don't know how strong Macau can be when China's very uneven. It comes down to basically how much gambling people want to do, how much gambling is going on over there. And is it China weakness versus Japanese strength simply a stock market perspective?
Yeah, I know Chinese, there was some Chinese data out last night that missed, but the focus really has been on the stimulus side, right? So stimulus going into the area, there's a lot of people been pushing with China to recover. There's also a lot of people saying like they're in trouble. But as we've known through many of the years, China's always going to support their economy. So
yeah. Gambling, also gamblers are gamblers over there. If there's some money to be made somewhere, they get the itch and they start gambling. Like they travel in herds over there. That's how investors are over there. So if they're all excited for making tons of money in Japan, they'll take those profits and run to Macau or elsewhere. So I mean, Las Vegas' biggest thing was Singapore, which is not China outright, so to speak. I guess it is, right? No, it isn't. I don't know.
Singapore's its own country.
I mean, I should know that, shouldn't I? That's just sad, isn't it? I guess I just have enough coffee this morning. Here. Anyway, no, Singapore was their big back in the spring. Singapore was the big shining piece. and that might be because Japan has been strong equity wise. So maybe Singapore carries them again, but people are looking at Macau, and that's what it comes down to.
Yeah. Oh, looking forward to seeing those numbers. So keep an eye on those. All right, we're going to get to the 3Ls now, and obviously with a week like this with earnings, we're going to have a quick look at 6 different names. Obviously not all the names because we can't get all of them in there. I'd love to put in 100 of them, to be honest. But we're going to look at these. Yeah, Brendan doesn't want it. All right, let's kick it off with Schwab. And they report Tuesday pre-market.
I always get Schwab wrong. I'm always on the wrong side of this, but I'll take another stab at it. Like it. Broke out above 56 but it has a bad weekly candle that followed this breakout. Trend looks like it wants to get to 60 though. So I like it.
Okay. Goldman Sachs, they report Wednesday pre-market. Bit of negative press going around this one lately.
Yeah, lots of negative press. Solomon, I'm surprised, still has his job. They absolutely hate him there, and he still has a job. Must have the goods or something. Anyway, leave it. Failed in the 65 week and backed off. I'd watch 315 for support, but the bottom looks like around 300.
Okay. Tesla is Wednesday aftermarket, and maybe we'll hear something about the Cybertruck.
I like it. It's funny how he's got more battles with Twitter lately than anything. And Tesla just quietly continues to beat up on the competition. Can't believe I'm positive. I know. Anyway, I like it. Near resistance of 290 last week, so that might encourage some selling. But I think if they continue the momentum, they're stealing momentum from everybody. They drop their prices and nobody can match it. Like Ford, GM, and all them are like, oh crap, they lowered prices. We can't. Anyway, you see more Teslas on the road these days, so I like it.
Okay. Netflix, they're Wednesday aftermarket as well.
And you'll be surprised to hear this, but I like it. In fact, I've been watching Netflix lately. No, I've been watching HBO Max. A couple good shows there. Anyway, I like it. Candles are getting smaller and smaller, which is sort of a worry. So it's sort of losing power behind it. But the uptrend's still in play.
Okay. Also Wednesday aftermarket is IBM.
Did you know these guys came out with the first? They had the AI. Watson was their AI before anybody,
Yep.
And they're way behind the competition. That's so typical Big Blue. I mean, they get out in front of anybody and they're left behind. I'd leave it. No pun intended. Tough one is sitting at one. It is sitting 1 penny lower than resistance, so it literally is neutral on the chart. So it's a coin flip. So I'm going on history here. They seem to be left behind on everything, so I'd leave it.
Okay, and the last one we're looking at is American Airlines, and they report Thursday pre-market.
So this one's fascinating because travel has been so gangbuster strong, but it failed on resistance at 1860. It's also had big selling on a weekly basis since May, which is kind of interesting. It might come down to capacity, and I think they still don't have enough capacity to make enough money, even though they're probably going to make a good. Delta was strong, I think, but I would leave it. It failed in 1860. Biggest selling. Looks like it's going lower.
Okay, well, that wraps us up for this week. Brendan, thank you so much for your time and good luck investing out there this week.
No problem. Have a good week yourself.
And for everyone else out there, good luck investing.